Welcome back. So now we have seen all the concepts, terms, all the fundamentals of premium and discounter rates. So let's have this final video in our series where we will summarize and add all the missing pieces together so that we can do some trading, which is what we all are interested in, right? Let's summarize what is price action and what is candle size. So what is price action? So price action is movement of price for a given commodity, stock, index from one PD array to another PD array. Why price moves? Price is always moving. This price cannot stay at one level in the market. Price is always moving. So why is it moving? So it is either seeking liquidity or offering a fair value. So what is candle size? Analyzing the candles in the price action to find market bias or the trend. So once we know market bias, we know where to take trade, how to take trade, which direction to take trade, whether we should buy or sell. So market bias is the most important thing before we start our trading. If bias is known properly, bias is calculated properly, our trade in that direction, either buy or sell, can make us profitable. So what are the different concepts that we have seen till now in this series of videos? Mostly we have seen the premium arrays, discount arrays, right? What are the premium arrays and discount arrays that we are seeing? We have seen it's fair value gaps, swing high, swing low, order flow, sharp turn, run on liquidity, breaker block, mitigation block, order block, first line of defense, last line of defense, overlapping defense, fair value areas, sweeping the liquidity, running the liquidity, and finally, the most important, two candle rejection. So these are all the concepts that we have seen, understood, or tried to understood in the last 10 videos. Another most important factor when looking at price action is the time frames. Which time frame should we refer to? Mostly month, week, day, 4 hour, 1 hour, 15 minute, 5 minute, and 1 minute. These are the most important time frames for MMT or ICT. What is this higher time frame? Month, week, and day, and sometimes the 4 hour. These are the time frames generally used for finding out the bias. So once the bias is known, then we can move to mid time frames or lower time frames for the entry, right? Then only we can. If bias is not properly determined, then there is no point in taking the entry or going to the lower time frames. The first important step while starting trading is finding out the bias in the market. That time bias is non-deterministic. It's better to keep away from the market and do not enter. We'll see how we can find out the bias, how to do the entries, when to do, how to do in the next video series that this series. So what are the market charts we can use whatever we have learned till now? Ideally, all the concepts are common for any type of chart, whether it is index, futures, commodity, crypto, any script, oil, gold, silver, anything. So all the concepts remain same for any type of commodity. Let's understand the basic fundamental steps before using this concept for our trading purpose or to enter the market. So all the concepts that we understood about the premium arrays, discount arrays, fair value gaps, fair value areas, order blocks. These are the steps that are most important. The first step is bias. What it tells us? Direction of price, whether it is bullish or it is bearish. The second most important thing or the concept or the step is narrative. What? What is the target? If we know the bias, what is the target? Where price is headed? Which premium array it is headed to? If it is bullish, if it is bearish, which discount array price is headed for? That's the narrative. The next important step is the context, finding out the context. What is context? Context is where the price is going from. Narrative is where the price is going to. So this is a target and this is a source. Price is moving from this context to the target, right? Once we know these three steps, the next step is entry. When to enter the market. Now that we have established bias, we have found out the target, the narrative, we have found out the context. Now the next step is the entry. Once you take the entry, the next step is to risk management. What is risk management? Once we take entry, if things go wrong or there is some problem in our analysis or the market changes the sentiment and price moves in the reverse direction, if something goes wrong, it is the level where we need to back off so that we don't drain out our account or we do not lose more money than we had a target for. So that's the risk management. We should always have risk management in place. Whenever we enter the trade, without risk management, one should not enter the market. How do we do risk management in the market? It's basically the stop loss. Okay, we'll see how to do risk management. So how to do bias? How to do bias, narrative, context, entry, risk management, everything. Let's understand how to find out the bias. How do you find out the bias? As we saw, bias, in order to find bias, we need to go under higher time frames. What are the higher time frames? Monthly, weekly, daily, and sometimes 4 hour. So on these time frames, we need to find out order flow legs or the FVGs. So once we find out order flow leg, active latest order flow leg or the latest FVG on the higher time frame, that is a bias. So if monthly is having a fair value gap, weekly is having a bullish fair value gap, also daily is having a bullish fair value gap. In such a case, when all three or all four time frames, hourly, monthly, weekly, daily, and 4 hour, all the time frames match in the bias or show the bullish fair value gaps, then we can say the bias is bullish. If any one of these time frame has different bias than other time frames and the time frames are not agreeing with each other, so it's better to keep away and not look for any trades. Once the bias is decided, all time frames are matching or showing us the same bias, we can move to find out the narrative. Narrative is the target. It is either swing high, swing low, or previous candle high or previous candle low. It is always the target. Next is the context. What is the context? It is the PD array from which the price can move to the target. So where can a price move from? It can move from a FVG, a 4 hour FVG, a daily FVG, or weekly FVG, or monthly FVG that we found out in the first step of bias. So from this fair value gap or fair value area or order block or mitigation block or breaker block, price can move to reach this swing high or swing low. That's the context. So once we found out bias, then narrative, and then create context, now it's time to get an entry. So once all the PDRAs are decided, now we can go on to lower time frames like 1 hour or 15 minutes, 5 minutes, or 1 minute time frame to enter. How do we enter? We should, depending on different time frames alignments, we can enter using candle science, we can enter using fair value gaps, or we can enter using order flow. What is the time frame alignment that I spoke of is we'll see in the next video. So once we enter using any of these three pattern, candle science, FVG, or order flow, depending on the time frame, we need to have the risk management. What is risk management? Which level should the risk management be assigned to? It is the highest or the lowest level price can retrace to within the context. So we are moving from this PDRA to that PDRA. So while moving from context to the narrative, context is the lowest or highest price from which price has started reaching the target. So it is the lowest or highest level price can retrace before reaching the target. So our risk management or stop loss should be above or below this highest or lowest level so that we do not close the trade, or we are going to take care of some buffer above these levels for risk management. If price goes above that high level or below that low level, that means price has reversed, our context and narrative has failed. It's better to come out of trade without losing a lot of money or draining our account. So risk management is the most important thing in our practice. So in a typical market structure, price is always moving from one PDRA to another. It is always moving from one PDRA to another PDRA, or either moving up or moving low. So when price is moving up, let's say there is a fair value gap created on a daily time frame, and higher time frames are showing a bullish bias. In such a case, once reaching some PDRA or some swing high or low, price can retreat. Once the price retraces to this fair value gap, it can reverse and start in the direction of bias. So when it is coming into this fair value gap, now this can be any discounter or any premium. Right now we are in the bullish scenario, that's why we are having this discounter. But in a very scenario, it could be any premium. It could be FVG, it could be any FVJ, it could be order block, mitigation block, or breakup block. So price can retrace to this discounter rate and then continue the original bias direction. So this is the context where price is moving from this fair value gap to this target. Which target? This swing high that was created before retracement. So this is the leg where we are going to trade. Let's see same market structure in terms of candle science or the real price action. This is how the fair value gap or fair value area got created by these three candles. So what is fair value gap? Again, it's a three candle pattern where the first candle's high and last candle's low has a difference, has a gap between them. And second candle is a big expansion candle. So this fair value gap is our context and the target is this swing high. So within this area, which is also called as area of opportunity, in this area of opportunity, we will take an entry on the lower time frame. So we need to understand how is time frame alignments is done for finding bias, finding context, and taking an entry that we will see in the next chapter. So this is the current level. From this current level, price can retrace to this fair value gap and then try to reach this target because our bias, original bias is bullish. Let's see the real gold chart. This is a gold chart for May 2025. Let's see. This is the expansion that we are seeing. On this daily time frame, we have this fair value gap created between these three candles. This is the first candle whose high is, and the third candle's low. There is a gap between them, and this third candle's close is above this expansion candle. So this is a breakaway gap. This close could be below this high, second candle high. In that case, it will be a perfect fair value gap. In this case, this is a breakaway fair value gap. In this fair value, now this third candle has retraced into this fair value gap, and then we have reached this target, right? So this is a retracement and then reaching the target. From this location, we have retraced and then we have achieved the target. So this is the context area on the lower time frame to enter the trade. So we can use 4 hour, 1 hour, 15 minutes, 5 minutes or 1 minute to enter this trade on the lower time frame from this fair value gap to this target, right? So let's understand the time frame alignment for understanding the context and the entry. So when you find context on monthly frame, your entry could be on weekly, daily or 4-hour time frame. So if you are taking entry on weekly, it can be based on candle size. If it is on the daily time frame, 2 time frames below, then it is a fair value gap. If it is 3 time frames below, at 4 hours, it should be an order flow. Similarly, for weekly, 1 time frame below, it could be candle size, 2 time frame below, on 4 hours, it will be fair value gap, 3 time frame below, it will be an order. For context on daily time frame, like if there is a fair value gap on daily time frame and we are taking entry on lower time frame on 4 hours, then this time entry could be based on candle size. If entry is on the 2 time frame lower on 1 hour, then it will be fair value gap. If it is on 3 time frame below at 15 minutes, then it will be order. Similarly, for 4-hour context, entry on 1 hour is candle size, entry on 15 minutes is fair value gap, and entry on 5 minutes is order flow. Now when we say candle size, fair value gap and order flow entry, what does it mean? When it is a candle size, for candle size we mean it by 2 candle rejection. Please, if you haven't seen the video for 2 candle rejection, please find, I have shared the link in this description to understand 2 candle rejection. For fair value gap, it is just a fair value gap creation on 2 time frames below. As soon as a fair value gap is created, we can take entry. If fair value gap is not created, or if there is no 2 candle rejection, then entries could be problematic. So in such a time, it is better to keep away from the trade. In case of order flow, it is an active order flow leg. Please check what is order flow and what is order flow leg to understand what exactly it is. In short, it is nothing but an price movement from one swing low to another swing high with an active fair value gap in the recent leg. It's an order flow leg. So I will suggest you to see my old videos in this series for understanding the candle signs, two candle rejection, fair value gap, and order flow leg for the entry context.